Good day, and welcome to Antony Waste Handling Cell Limited Q3 and 9 months FY22 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jose Jacob, Chairman and Managing Director, Antony Waste Handling Cell Limited. Thank you, and over to you, Mr. Jacob.
Good afternoon and a very warm welcome to everyone present on the call. Along with me, I have Mr. Subramaniam, Group CFO, and SGA, our Investor Relation Advisors. I hope and pray for your continued safety, health, and security, as well as that of your families. Our investor presentation is now available on the stock exchanges and the company website. I'm happy to report that we had another record-breaking quarter in terms of revenue, exceeding previous quarter high due to growth in tonnage from both commercial and residential areas in which we operate. We believe the impact of the third wave of the COVID-19, namely the Omicron variant, is not very severe, and economic activity has started to normalize sooner than expected. In the future, apart from the normalization of economic activities, new contracts will enable volume growth for our company. Now moving on to business-wise performance. Municipal solid waste collection and transportation project. In this service, we have 13 ongoing projects, and all the region in which Antony has operations are showing sign of positive growth. Our municipal solid waste collection and transport business registered a year-on-year volume growth of 13% in Q3FY22, and on a sequential basis, it registered a growth of 3%. I am pleased to report that during quarter, our wholly owned subsidiary AG Enviro Infra Project Private Limited was awarded a 10-year municipal solid waste collection and transport contract to disposal site and operation and maintenance of equipment machinery from the city zone and Sadar Pahagan of North Delhi Municipal Corporation. This contract is for the collection and transportation of approximate 1,000 tons per day. This contract has a dual revenue. Not only will be getting paid on tonnage handled, there is also a user fee collection model. The user fee collection will be split in an 85:15 split between NDMC and AG Enviro. Waste generator will be charged fee by the operators for the door-to-door collection and transportation of solid waste from households, commercial shop, establishment and bulk waste generators under the user fee collection revenue model. NDMC will fund a portion of the capex, while AG Enviro will fund the remainder. We expect the contract to start operation by May or June of the current year, but few wards can see some operation as early as end of February itself. It depends on the ability of the corporation to provide us the requisite equipments. Coming to municipal solid waste processing projects. For the 9-month period ending 2021, we have processed approximately 10.61 million metric tons of waste in our municipal solid waste processing projects, which include both Kanjurmarg and Pimpri-Chinchwad. The Greater Noida biomining activity billing will commence in the current quarter of Q4/22. The volume at our waste processing business grew on a year-on-year basis by 6% in Q3FY22, and on sequential basis, it has improved by 4%. In Kanjurmarg, we have commenced biomining. Our first cell is in order to convert it into contains to compost and RDF for further sale. The activity was slightly delayed due to the late exit of monsoon in this part. Our Pimpri-Chinchwad waste-to-energy project is on track and plant is scheduled to be fully operational by March 2023. During the quarter, the Board of Directors of Antony Lara, a material subsidiary, has approved the conversion of 3.5 lakh convertible preference shares into fully paid up equity share at a 1:1 ratio. As a result of this corporate activity, the controlling interest of Antony Waste Handling Cell Limited in Antony Lara has increased from 63.04% to 73%. Also during the quarter, Antony Lara has been recognized by the CIA with the prestigious Merit for Excellence in Managing Municipal Solid Waste Award for effort in managing municipal solid waste in India. This award recognizes our entire team dedication to all of our plants as well as all of our support functions. This award is dedicated to all of our employees who have always done their job even in the face of adversity such as the COVID-19 pandemic. Additionally, during the quarter, the result of the Swachh Bharat survey was disclosed, and I'm happy to inform that a few of the cities in which our company operates, that is Noida, NDMC, MCGM, among the others, have scored high ranks. It is our continuous endeavor to provide quality service to our clients and help them in the path of sustainability and proffering a better quality of living to its residents. This is from my side. I now hand over the conference to Mr. Subramaniam, our Group CFO.
Thank you, Josh. Good afternoon, everyone, and thank you for joining us for our third quarter 2022 earnings conference call. The year 2021 has been an eventful year at Antony Waste. We have completed our first year of being a listed entity, and during the calendar year, that is the 12 months ending December 2021, we have processed approximately 1.9 million tons at our Kanjur facility. This is the highest tonnage being processed at our site till date. The year has also seen the company build on its organic growth and also bag and build on 3 new contracts, namely the Greater Noida Biomining, Jhansi, and the recent NDMC C&T contract. During the third quarter ending December 2021, the company reported operating revenue of rupees 148 crores, up 26% year-on-year, and a total revenue of around 165.8 crores, which is up by 30% on a year-on-year basis. Sequentially, these are up by 4% and 5% respectively. The growth in core revenue was driven by a tonnage increase in both commercial and residential areas in which we operate. Operating revenues increased by 36% to 422 crores for the 9-month period ending December 2021 compared to 309 crores in the same period last year, while total revenue for the 9-month period is up 38% at 474 crores. Consolidated adjusted EBITDA has registered a marginal growth of 1% to 43 crores in Q3FY22 compared to 42.4 crores in Q2FY22, with an EBITDA margin being 26%. The EBITDA was impacted by provisions made on account of our conservative approach towards delay in the reconciliation of billings in the user collection fee model projects. The provision under these are to the tune of around 6.8 crores. Let me put some color on this. Based on the new billing model of the user collection charges, our revenue recognition is from the household and commercial units, especially in the projects of Varanasi and Jhansi and also in Noida. In collaboration with our clients and as per our tender conditions, we have implemented a more transparent technology to aid in the processing of error-free billing by adopting GPS-enabled geo-fenced and an RFID-based billing processes and have moved away from manual entry. The reports and bills generated from our systems need to tally with the property card records and property descriptions of the corporation. We have noticed some discrepancy with respect to the same. The company has decided that till the time the corporation systems are not updated and reflecting the ground picture, to go with the corporation's records for billing purposes. Though this doesn't entail any additional operating cost for the company, what this means is a conscious deferment of revenue to the tune of approximately 3 to 5% of that particular site, or approximately around 5 crores per annum. We are confident that the same will be addressed in the forthcoming quarters. Please note that there is a potential increase in revenue as and when the scope of our work in Varanasi is increased. Currently, we are providing services in 90 odd wards, and there are 30 odd wards where our services can be started, but this is pending facilities being provided by the corporation. Furthermore, in the case of the user collection fee model, we have adopted a policy to fully provide for bad debt reserve in cases where bills remain unpaid for more than 180 days. As a result of these, we have taken a provision of approximately 6.8 crores at the consolidated level in the quarter ending December 2021. We are collaborating closely with our clients to help smoothen and speed up the billing processes as well as improve accuracy and ease of verification. Additionally, during the quarter, our employee cost has risen by 9.2% sequentially. Part of the increase is on account of a revision in minimum wage rate and the change in categorization of our employees, and the same will be reimbursed to the company in the subsequent quarters by the respective municipal corporations. Also, the increase in employee cost is due to the increase in headcount due to our scaling up of our operations in Jhansi. For the 9-month period ending December 2021, the adjusted EBITDA stood at 127 crores with 27% margins. Profit before taxes was 23 crores for Q3 22 or 14% of total revenue, and for 9 months it was 79 crores or 17% of total revenue. Profit after taxes stood at 19 crores for the quarter ending December 21, and for the 9-month period it is 65 crores. Please note that the year-over-quarter had lower tax provisions due to losses incurred amid pandemic situations. Coming to business-wise performance, our MSW CNG revenue is up by 4% to 109 crores during the quarter as compared to 105 crores in the last quarter. The growth was on account of increase in total MSW CNG volumes by 3% sequentially. Processing revenues are up by 5% at 39 crores versus 36.5 crores in Q2, reflecting a 4% increase in my tonnages being processed on a sequential basis. On the balance sheet front, our net debt to equity as on 31st December 2021 was maintained at 0.2x. The total debt as of 31st December 21 stood at 143 crores compared to 150 crores in 31st December 2021, and net debt is as of December 21 is at 79.4 crores. Net worth has improved to 507 crores as of December 21 versus 443 crores in March 2021. The improvement in our overall credit profile of the company has resulted in lowering of average cost of borrowing at a consolidated level by approximately 380 bps. Our receivable days as of 31st December stood at 74 days, and this is a critical metric that we would like to watch out for. Our capital return metric remains strong with a return on capital employed of 19% and our return on equity at around 16% as of December 21. Now, on an update on the search conducted by the Income Tax Department officials at our companies and subsidiaries premises, there is no additional request or inquiry from the tax authorities, and we are still waiting for the response on this matter. We'll keep you guys informed and the stock exchange is updated, and we would like to reiterate that the proceedings have no effect on the company's operational performance. That's it from our side, and we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Hardik Jain from ISJ Securities Private Limited. Please go ahead.
Yeah, thanks for the opportunity. Sir, our major cost is is fuel, and so most of our contracts, do they have escalation clause in them because fuel cost has increased a lot over past 1 year or something?
Good evening, Hardik. Yes, all our projects have escalation clauses. Approximately 45% of my projects have fixed escalation, and the balance 55% have variable escalations. The escalations do capture the changes in fuel, labor costs, and also miscellaneous items. The contracts are normally having an annual escalation, and sometimes over the last 3-4 years, what we have noticed is newer contracts have a escalation half yearly and sometimes even monthly or quarterly. So to answer your question, we have escalation across all our contracts that we have today.
Okay. And now in most of our projects, like say MSW CNT project of Thane, which actually expired in 2020 but is under extension. Likewise, Navi Mumbai is about to expire in 22, Mangaluru again in 22, and some of the projects are like Noida, Zone 1, Zone 2, and all of these projects have expired, but they are under extension. So what kind of clarity do we have that whether these contracts will be extended for next 5, 7 years, 10 years, or how should we see these contracts which are actually expired but under extension?
So these contracts have expired and it is under extension. One reason was because of COVID. They had to call for a fresh tender, but they couldn't because of the pandemic issue. But now they will be drafting the tender. So I think we may get an extension of maximum another 1 year. And when the tender comes out, bid comes out, we'll definitely bid and try our level best to win back.
Normally, Hardik, our ability to renew very high, like the ones in Navi Mumbai, NDMC, they have been, and even in MCGM areas, we have a very high strike rate of renewing the contracts. So the latest one that we renewed was in NDMC, where we were doing a part of the zone. We were doing a Safdarjung area, and now when the tender was brought in, we managed to back the entire zone at a higher tipping rate, and also the increase in scope of activity.
Okay. And my next question is, sir, we have around 12 lakh compulsory convertible preference shares, I think, still outstanding. So by when this can get converted?
Hardik, these were outstanding as of 31st of December 2021. After that, consequently, in the first week, once the demat accounts and everything was opened, we got those shares converted. So as of today, there are 0 convertible preference shares of Antony in Antony Lara. That the entire thing has been converted.
Okay. And my last question is, sir, we in Pimpri Chinchwad, how much amount we will invest over next 1 year, and what kind of revenues we can expect over a long term from Pimpri Chinchwad project?
So we have an incremental capex to the tune of 24 crores, which would be spent over the next 12 to 15 months. That is what we estimate to be the range. And normally we don't comment on the size of site-wise revenue generation model, but it's very simple to look at it on the tonnage and the rate of unit that we have managed at. So at Pimpri Chinchwad, the revenue source is dual. One is from the tipping fee, which is at around 504 rupees per ton, and we will be managing and handling around 1,000 tons per day. Further, the plant at its peak would be generating around 14 megawatts of total power, and the net metering would be around 11.5 megawatts. And these units will be sold to the corporation at 5 rupees per unit fixed for the entire tenure of 21 years.
Okay. Thank you, sir. I'll get back in with you.
Sure. Thank you.
Thank you. The next question is from the line of Anupam Gupta from IIFL Capital. Please go ahead.
Good evening, sir. Just a couple of questions. Firstly, on the PCMC capex, so we haven't seen any uptick in the last few quarters there at all. And given that we have a commissioning deadline of March 23, what is the status as of now? How much is invested? How much will you and how will you ramp it up over the next few quarters?
Good evening, Anupam. We have invested approximately around 7.5-8 crores in the last quarter. The reason for the delay was the withdrawal of monsoon in the western side of the country was long. So the civil activity could not get started at the pace that we have liked it. But happy to inform you that mid of November onwards, the pace has increased and we are still holding good to the timelines that has been given to us by our contractors. So we expect the project to not have any additional time overrun in this aspect. And we are actually looking at options to crash the project, save us more time, and also we'll try to incentivize the contractors if they are able to bring the entire project to fruition in the timeline that has been given to us by the corporation.
So what is the total capex which has happened till date? including last quarter?
Around 36 crores.
Okay. And you have a total of 240 to invest, right?
Right. That is the total capex, including the interest capitalization and everything. So we are very much in line with the speed and activity.
Okay. So as of now, we should not build in any delay there.
We are not building any delay over here.
Okay. And secondly, if I look at your overall escalations, so let's say as on 31st December, what proportion of cost would be left to be passed on to customers through escalations?
I would normally, a bulk of our revenue escalation kicks in from February, March onwards. So based on what has actually been passed and given to the company in lieu of escalation, I would say around 60% of my revenue escalation has been given to the company. The balance 40% revenue will be given escalation from February onwards.
So let's say if I were to take in terms of margins, if entire thing would have happened in third quarter, the margins would have been higher by what proportion? What percentage point broadly?
See, bulk of it is collection and transportation, so we would be slightly better off in the range of around at least 80 to 120 bits.
Okay. Okay. So basically, fourth quarter margin then should look much better than third quarter, given that escalations will come through in 7 March.
Yes, the margins in Q4 should be slightly better than Q3 margins for us.
Okay. And just one last question on the sort of provisions which you detailed here. So obviously, a part of these would have you would have known that these will happen even before you ended up accounting for these in the end of the quarter. So what would help is a slightly better idea or better contract this thing so that we have clarity of what sort of margin trajectory can happen. Because this upfront guiding of these things would actually help. So this
Definitely. So Anupam, what has happened is we have not only actually had a physical count along with our own team and the technology platform, but we also involved the health officers of the particular wards and the corporation, and they have physically verified it. So there is still a discrepancy in the accounting norms of how property cards are issued and designed and deciphered as compared to the physical count. So this is in lieu of the delay in the census numbers and the counts which get ratified over a period of time. So what we have done is we have lodged our billing based on actual numbers, but we are going ahead with the billing receipts based on what the corporations have in their records as of today. So if there is any reconciliation that happens in future, you will get a retrospective effect for the same. It's too early for us to say by when will this activity be commenced successfully.
Right. Okay. That's all from my side. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Jigar Shah from Maybank. Please go ahead.
Yeah, hi, good evening. Thanks for the opportunity. My first question is regarding your carbon footprint. So you employ a lot of vehicles for the carrying of the waste, the transportation. Also, I think the waste processing generates a certain amount of emissions. So can you give some idea about the emission profile of the company and what's the strategy to tackle that?
Yeah. Good evening. So yes, we are very aware of the kind of impact that we are having on the environment. So if you look at our business, we can keep it into 2 parts. On the collection and transportation business, what the company has adopted is all the primary collection, which are basically smaller sized vehicles. Those are now being migrating out of the diesel fuel based injection into a CNG/an electronic vehicle. The company is planning to increase its EV footprint on the smaller sized components a bit. Unfortunately, the large size compactors and my forklifts and specialized equipment still will be using diesel as a fuel mechanism. So unless and until I get support from the automobile industry to replace the large engines out, I would still be relying on them. But the smaller sub 1 ton machines will be shifting to a CNG footprint on an aggressive mode. The company has just gone ahead and purchased 40 more EV vehicles to be used across its sites across the country. On the waste processing, in Kanjurmarg, for example, we have a waste to energy component wherein 0.97 megawatt of the power is generated from the landfill gas that gets captured and tapped internally. So that entire thing is capitally consumed. So to a great extent, the methane emission is controlled. In the waste to energy section at Pimpri Chinchwad, which is under construction, the entire waste will be controlled, converted into green energy and will be pumped back to the grid through the corporation. So these are steps that we have taken. We will be shortly publishing our ESG report, which will quantify these numbers and will be open for scrutiny from any other third party that wants to look at the same.
One more quick question. What are the practices of other waste management companies or their models which you would have seen outside India, which you admire, and what over a period of time can be incorporated over here?
What we actually like abroad, and I sincerely hope the same gets implemented in India, is the level of segregation. In India, what we collect is a very highly mixed form of waste. Both wet and dry waste gets mixed and handed out to the waste operator. Globally, your dry waste, the wet waste, the recycled waste are given so separately, so that it's easy for the end consumer, like an end operator, like an Antony Waste or a waste management incorporated kind of entities, to extract resources in a more efficient manner and reduce the impact on the environment. So the waste that ends up in the landfill is significantly of an inert nature than what happens in a developing economy, especially at countries like India, where segregation is still to be caught on a serious footing. So that is one thing that we are watching for. Maybe the government will crack down hard on segregation, the need to segregate it into various formats, and we have facilities to collect waste in segregated format, but when the inflow of waste itself is mixed, there is very little that an operator can do over here.
So thank you very much and all the best.
We have also implemented RFID tags on our bins so we can read the locations, like in collection and transportation, which is being implemented vastly in Europe, and so we know how many bins are lifted every day. So our company is always looking forward for new technologies and ideas. Even our waste processing, that is composting unit, our material recovery facility is one of the best in the country, because we adopted a similar facility which we seen in San Francisco, and our composting system, which is also controlled totally by SCADA with zero human intervention, due to which the quality of compost is very good, and all the fertilizer company is appreciating and they're buying, and there's a huge demand for it. So basically, at Antony Waste, we always look outside what are the best technology being implemented and cost effective. Because cost also plays a very sensitive role in our market. So that's what we are adhering presently.
Thank you and wish you all the best.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Nikhil Chaudhary from Chris Portfolio Private Limited. Please go ahead.
Yeah. Hi, sir. Good evening. And
sorry to interrupt you. May I request you to speak louder, please?
Is it better now?
Yes.
Yeah. Thank you for the opportunity. Sir, I wanted to understand more bit on the user collection model. Apologies if it is a repeat because I joined a bit late. So can you explain it, like if this model continues, the risk of a receivable, can this be something that probably continues going forward, or is it just a one-off thing and probably going forward? I heard something that integration is pending in respect to the corporation and your system. So is this a one-off thing, or this is a risk in this model?
Yeah, so this is something user collection model globally in many developed countries is already going on. So in India, it has just been recently implemented in many municipalities. In Noida, where we are doing presently collection transportation, we have a user fee model. So going forward, this will reduce the stress on companies like us, for receivables and being totally dependent on corporation. So part of our risk will be reduced, and we will get paid from the commercials, housings, and all that. And as years goes by, I think user fee may increase and can reach to a level where the company just need not be dependent on corporations' payment. So, but this is a start, and which is a good start for our industry.
Just to build on that, so these are teething problems. So when you were to do an actual survey of a zone or a ward, and if you were to actually do a count of the households, that normally has a lag effect when you look at the property rate cards in different cities. So we have learned it wherein we need to take the corporation together and verify the counts so that there is we avoid such kind of overstatement and then provisioning kind of an issue. So this is something that we have learned. We don't foresee similar activity to happen in future because we have got the consensus along with the corporation department heads that these are the counts and this is what is going to be. Till the time they verify it, there won't be any significant swings in the revenue recognition pattern.
Understood. So just a bit clarification, in the end user, in the user fee collection model, we collect or like the user pays it to the corporation and then they share it with us?
Sorry, we couldn't get that question clearly.
No, I was just trying to understand the user fee collection model. Like we don't probably like collect it from the commercials or some the commercial shops and the end users. I meant like the corporation collects it and then it is distributed. It is shared with us, right? Like
we collect it as a company. The collection scope is given to us, so we have our team to do the collections.
Okay, understood.
So the vendor gives you the scope, whether you collect it and keep it with yourself or you collect it on behalf of the corporation and hand it to the corporation. So scopes are determined in the tender itself.
Okay. Because I was just trying to think aloud, like if it is a one-party collection, like if we have to collect it with the corporation, we just have to deal with one party. Here we have to deal with several users in this model. So I was just trying to think like how probably going forward, will it not be a more challenging task for us, or like this is the way forward that we intend to work?
Normally, in user collection model, as in other areas, we have the ABC kind of a structure wherein 80% of your revenue will be contributed by 20% of the generators, which would be commercials and other large generators. The units, the residential units will be smaller. They will be definitely be numerous, but the impact on the revenue will not be as significant. So this is like your Mahanagar gas or any of the utility bills. It's something which is happening for the first time in the country. So till the time there is a very easy and a smooth process, there will be some hiccups over here.
So what we have noticed is the user fee, people are willing to pay. So that's nobody, like say you have to just pay a fee of 50 rupees per month. So it's not a big money which is in. And when we go to society, we get paid from the society. We don't go to each and every.
Understood.
Yeah.
Okay, understood. That's it from my side. Thank you and wish you all the best.
Thank you.
Thank you. Next question is from the line of Manav Vijay from the Financial Consultants. Please go ahead.
Yes, thank you very much, sir. Am I audible?
Yes.
Okay, thank you. So, sir, my first question is regarding the NDMC project that we won last quarter. So, 1,000 crore project, 10 years. So would it be safe to assume that it would be 100 crore per annum?
It is a fair assumption to have.
Okay. So second question regarding to that. So we were already involved, I would say, in the NDMC region, and we were already doing some. So would it be possible for you to quantify as to what would be the incremental revenue, or we should assume 100 crores per annum as the new revenue from this contract?
I think it is a fair assumption because that would we don't normally get into site-wise details, but it's we are okay with that statement of an incremental annual revenue once the project starts at full throttle to generate an annualized revenue in the tune of around 100 crores.
Okay. And and would it be also possible for you to detail out the capex involved in this project?
Yeah. So now in this project, we estimate the total capex to be the range of around 101 to 107 crores. It's just getting it thrashed out in the last final bits because of the price escalation that's likely to happen from 1st of March or 1st of June, as the case may be. Approximately around 30 odd crores will be funded by the corporation. The balance, the company would need to fund the same.
Okay, so approximately 70 crores is what you will spend between quarter 4 and quarter 1 put together.
Depends as and when the corporation provides it, but yes, we would like to get the entire thing done before the monsoon starts.
Sure. Okay. And sir, in terms of, let's say, step-up function like the way we have in Kanjurmarg, there is no step-up function over here. So when you say you will have to collect 1,000 tons per day from these areas, so this starts from day 1. There is no step-up.
Normally, the scale-up of operations starts zone-wise or ward-wise. So it's not that from the press of the button, the 1,000 tons start kicking into your system. So it's a gradual process. You slowly roll out your machinery, you garner more and more equipment, you put them on the ground, you start taking over the controls from those wards. So it takes normally 3 to 6 months for the entire mobilization to happen. We expect the start of work by somewhere end of February onwards, and the 100% scale up to be done before May end or even June. If things go as per schedule and everything happens, so by June end we should be 100% on the ground.
That means from quarter 2 we will have full revenue from this contract.
If everything goes as per plan, we are able to mobilize the assets, there are no hiccups on the delivery of equipment, yes.
Perfect. Okay. My second question is, sir, is regard to some of the one-off that you have made in this quarter. So for the 6.8 crores provision that you have made, so this is a one-time and going, that means in quarter 4 or further, all the further quarters, we will not get to see this kind of a year provision, and you will get a refund of this amount. Maybe timelines are difficult to estimate. Is that a fair assumption?
That is a very fair assumption. Of the 6.8 crores, we are very positive up to 1.2 to 1.4 crores to be reversed by the end of the current quarter or maybe the first quarter itself, because that work has already been started and that is getting verified. But the pace is something that we would not like to comment and build it at this stage.
So what I would basically ask you is that so this is 6.8 crores is a one-time provision. Quarter 4 or quarter 1, we will not have similar kind of a hit.
Yes, it's a one-time provision for the cumulative work that we have done in these sites. It's a one-time provision that we have taken.
Okay. Now, is it possible for you to also quantify the increase in employee expenses because of the minimum wages and the recognition and everything? Would that be possible for you to call out that number?
Increase in minimum wage and the categorization that's had an impact in Q3 is to the tune of around 2.28 crores. The entire amount will be reimbursed in Q4 by the corporations.
So you will get this money back in Q4 only?
Yes.
Okay, fair enough. My second question is, sir, I would say in quarter 1 and in quarter 2 call, you mentioned that roughly 65% of your contract got renewed in terms of price escalation, and then in quarter 4 we should, I would say H2, we should have a revision on the remaining contracts. Now, what you mentioned in one of the earlier participant question is that the February is when we should have the price revision for the remaining 35%. Now, going forward, we should be, so that is how we should be building in as to, let's say, maybe by May or June, we will have 65%, and then by February, we should have 100% revision.
Assuming that I don't bag any new contracts and there is no significant change in my revenue contribution from these projects, then this assumption of yours will stand good. But what we foresee is when NDMC and Varanasi kicks in and even Jhansi kicks in a bigger way, the escalation metrics will slightly change. We will definitely update the team as and when these things happen.
Sure. Okay. Sir, my next question is regarding these three projects that there is mentioned. So Varanasi, Jhansi, and Greater Noida mining project. So my understanding was that these projects are supposed to add close to 9 to 10 crores per quarter to your top line. And I was estimating that we should have this number in this quarter 3 that just went by. Now the quarter-on-quarter jump in revenue is just only, I believe, 4 crores. So now in quarter 4, we should have all these three projects in full operation and the consequent revenue to that.
We expect, yes, Greater Noida to be 100% on for Q4. Similarly, Jhansi, we have rolled out all the machines that have been given to us by the corporation. If you remember, Jhansi is a project where the capex has been funded completely by the corporation. They have not handed over the entire capex till date. So whatever capex that they have given, we have been utilized it. So, but it's still not serving our purpose. So we expect additional assets to be handed over by the Jhansi corporation shortly. So as and when those assets are deployed, you will see a spike in our revenue. In Varanasi, yes, what we have seen is almost 80-85% of our peak revenue. So we want to just get it confirmed once again with those corporation agencies and the department before we jump the full throttle here.
Sure. Okay. My last question would be, so between, let's say, quarter 2 and quarter 3, one of the major items that has changed in your P&L is the decrease in the diesel prices of close to 8 to 9% because of reduction in taxes. Now that happened closer to end of quarter 3. So in quarter 4, we should get to see the full benefit of that because fuel is approximately 19 to 20% of your total cost.
Except for Nagpur and TCMC, which have a monthly escalation, all my other projects have mostly a half-year or annual escalation. So the escalation which has kicked in today, I will be able to enjoy it for some time. The benefit of lower fuel costs is also offset partly by higher wear and tear of the machines because age of the machine also catches up. So the benefit from the lower fuel price in the interim or any small benefit that may get, I'm just saying, I'm being very cautious and conservative here, might get slightly offset by slightly higher repairs and maintenance costs as we go towards the middle of the life of these projects.